Very two interesting weeks since I put out my last update. Uh, at that point, I was actually considering the possibility that you would get an extension in the counter-type autumn cycle. Is that still happening? I don't know. At least the short-term market situation does not look too good, and I think that needs to be watched. I did put out a warning on how the mid-cap index had actually broken its long-term trend lines, and I think at least the trend line since the May low. And the Sensex this week actually broke a similar trend line after a lag. In fact, it's also broken its 20-week moving average. So all of that gets us to question what's really happened here. I think the first thing to know is that I was doing one comparison that is with the 80s, where the index actually consolidated in a particular range and then broke out, and you could see that in the RSI, which was a falling channel and then broke out. Now, after that, we did get significant trends up, but then there were several halts even then. After an initial rally and a sharp one, the index did correct or consolidate at a higher range before continuing still higher. So, is that still happening now, or is this the end of the bull market? I think the wave counts are open for both. The risks right now need to be watched. What could happen here is, though, in the short term, we are still not very oversold in terms of the RSI. It's still not at 30 or below, so which means there may still be some short-term downside. At the same time, it's possible that we saw very high volumes in the last 2 days in the market, and that may have done some short-term capitulation, and you get a bounce back maybe to the 6,000, 6,050 Nifty. Now, if that happens, you might still get another round of selling is possible, because the weekly momentum indicators are showing that it might not be done with, which means you can go back and retest the breakout level of 18,500, or retrace the entire rally since the May low up to 61%, which gives you up to 17,900. So these are two possible extreme levels that may be reached. Until you really break 17,900, which is a 61% retracement, it's possible to try and count this entire rally as maybe a wave one of three, the beginning of the first rally of a move that may have further upside to go. And after that correction or retracement, we might start another leg up. That's something that we cannot, technically rule out. But the way this has happened, which means you got a double top at 21,000 and the mid-cap index falling off from a 78% retracement, the risk of the bear market resuming is a real one, and we need to really watch it closely. So, and since that was my original view for a long time, I cannot really rule it out yet. So, what are the things to watch? I think one of the risks that we've seen for the inflation-deflation cycle, and most of the tops that I called last year were preceded by rallies in the dollar. So, we have another dollar rally coming up. It's visible across currencies, which means not just the rupee dollar, which has also formed a double bottom at 44 and looks like maybe starting a multi-week or multi-month move up. It's also visible in a lot of the other currencies. Sometime back I was talking of the Australian dollar. It's made a head and shoulders stop and started falling. You're seeing the Taiwanese dollar turnaround, Brazilian real turnaround, Mexican peso turnaround. So all of them are turning around against the dollar. So you have a dollar rally setting up. I think if the euro breaks 1.32, then that's the last possible wave count, which is basically a 61% retracement of its last rally since August. If that breaks, then clearly the entire move of the euro since May would be an ABC corrective. The chances are already 90% that it is corrective. This would be the last level test, and if that happens, then one thing is sure, you'll get selling probably in metals, commodities, and world equities, and that could put some short-term pressure on various markets. But as we saw last year, despite a dollar rally, every time the dollar halted, we even saw Indian markets move up and retest their highs or even see a higher high. So, which is why what I'm saying is that even though you get a deeper correction because of weakness in other markets apart from our local issues, it's possible that once one round of selling is done is when we would be able to actually judge whether it was a correction and you start a fresh move up. If 17,900 holds, that potential would remain open, that you just corrected one move which started from the May low to October, and you retrace 61%, and then you start wave 3 of a larger move up going to a new high. So that's something we'll have to keep open. But given the risks that we did do a double top, that the US market is still within 61% retracement, which could be a wave B, and given that commodities have come off from readings, extremely high readings not seen in a very, very long time in terms of the daily sentiment index, gold, silver, dollar, all of them seeing 90 to 97% readings all together in the month of November, is a sign that you've reached the sentiment extreme on the upside for the commodities and currency segments. And that can be a signature that the bear market has started. So you really need to be careful on long positions still for some more time while this correction is still on. Bounces should be used to hedge or sell. And once it's done, we'll try to take that call as to whether things are getting worse. And then any bear market does have bear market rallies. So even in 2008, after the initial leg sell off to 15,300, we bounced right back to 18,600. So you do get big retracements during even bearish trends, which allow you to actually judge that where things stand. So I think right now the short-term trend is still weak, the medium-term trend is still weak. So every bounce would be weak and could see further selling. So the downside still exists over here, and we'll take the judgment on the longer term a little later. But I think I'll keep the preferred count now back to my original one, which was of a bear market rally till it is proven otherwise. At the same time, we'll watch 17,900 just in case there is something else playing out, because deep corrections after significant rallies are normal, and you should not really rule out everything. And if something does develop in terms of an extension of the counter-typhotum and and a further inflation rally for India, then we should be able to capture it from 17,900 upwards to a new high. So we'll try and see if that is happening and try and capture that. But watch out for short-term weakness, especially if the euro breaks 1.32, in which case you'll get weakness from other markets rather than just the local issues putting pressure on equities. That's all from me this week. Thanks and bye.